Reports of CME or Globex feed instability, hit metals mid-rally, execution got messy, and silver stayed defended right around $90 on the main benchmark feed most of you watch. That's not nothing. That's pressure. I'm not claiming motive. Timing doesn't prove intent. I'm talking mechanics. What happens to liquidity when the plumbing stutters, and what it means when price refuses to give back a major level during that window. Now, before we go any further, receipts matter. If you have an official CME incident log, a status page screenshot, a broker bulletin, or time-stamped platform notices, drop them in the comments. I'll pin facts. If all we have is my broker froze, we treat it as reported instability, still important, but we keep our language accurate and defensible. And one more precision point so nobody can nitpick this into a comment war. When I say held around $90, I'm referring to the benchmark chart feed you're using, futures or spot depending on your platform. Some feeds may have printed 89.60, others 90.10, because that's exactly what instability does. It fragments the signal, so don't take my word for it. Verify it on your own time-stamped chart around the outage window. All right, here's the punchline early so we don't drift into teacher mode. The outage isn't the story. What price does after it? That's the story. Because anyone can talk about glitches. Pros talk about outcomes. And the outcome we're watching is simple. Did the market defend the $90 area under degraded conditions and then confirm that defense once conditions normalize? Or did $90 only hold because liquidity was fragmented and the real selling shows up the moment trading becomes clean again? That's why this is pressure. Pressure is not what people tweet. Pressure is what price refuses to do. Now let's break this down cleanly without overclaiming anything. When a major benchmark feed becomes unstable mid-move, price discovery doesn't pause. Other venues can still trade. OTC desks still quote. Spot prints still happen, but the quality of price discovery degrades. It becomes fragmented, less reliable for confirmation and execution. And in a leveraged metal like silver, confirmation and execution are the entire game. Here's what that looks like in the real world. Fast and simple. Liquidity thins, spreads widen, quotes lag, some orders reject, some fills slip. Different participants see different prices. That last part is the key. Different participants see different truth. That's why you'll see comments like, my feed never went down. My broker froze for 5 minutes. I saw $90.20. I only saw $89.70. All of that can be true at once during instability. So we don't argue about feelings. We collect receipts and we analyze behavior. Now, why does holding around $90 during instability matter at all? Because $90 is a behavior zone. It's where breakout buyers chase. It's where shorts defend. It's where headlines get written. It's where option desks may have to adjust hedges. If open interest is concentrated around the 90 strikes for near expiries, conditional, always conditional. If the options chain isn't loaded around $90, ignore the gamma talk. If it is loaded, moves around $90 can be amplified because hedging flows can accelerate. How do you verify that? Check your broker options chain, open interest by strike and expiry. If you actually trade options, that's your map. If you don't trade options, don't overcomplicate it. Watch price acceptance. Now here's where we tighten the logic so we don't backtrack later. Holding around $90 during degraded conditions can tell you something about the bid underneath, but we only confirm it after normal conditions return. That's the honest framing. Because there are two reasons a level can hold during instability. 1, genuine demand is supporting the level. 2, liquidity is so fragmented that the market temporarily can't push cleanly through it. And here's the nuance that keeps us accurate. Degraded liquidity can either protect a level temporarily, or create air pockets that slice through it like butter. Depending on who is still providing liquidity and how aggressive they are, it can slow a break, or it can accelerate a break. There is no one direction rule. That's why we don't conclude. We watch what happens next. Now, before we do scenarios, I want to ground the paper versus physical discussion with anchors that don't require you to trust me. Anchor 1, physical premiums and lead times. Check 2 things. Premium percentage over spot on 1-O's coins versus bars. In-stock availability versus pre-order lead times. Compare to last week. If spot is holding around $90 and premiums remain elevated, physical isn't behaving like a weak market. If premiums compress quickly and inventory floods back, physical demand is cooling. And one line to keep this honest, premiums aren't a prophecy, just a stress gauge. They don't guarantee a squeeze tomorrow. They tell you whether real-world buyers are behaving differently than paper traders. Anchor 2, inventory and delivery behavior. Watch registered versus eligible trends and net changes over time. If registered keeps trending lower while delivery behavior remains firm, that can indicate tightening, evidence, not proof. How do you verify? Use the warehouse reports and track a weekly trend. One day means nothing. A trend means something. Now here's the part that most people miss, and it's why your title is correct. When the plumbing stutters mid-rally, the market's first job becomes repositioning, not fair pricing. And repositioning usually happens through pain. Stops get triggered. Weak hands get shaken. Leverage gets punished. Confidence gets tested. That's why the same move can feel like a breakout to one person and a trap to another. So we don't pick a side based on feelings. We map the structure. 2 scenarios. Bearish first. In the bearish scenario, $90 held around the level during instability, but once conditions normalize, the market fails to accept above it. Here's what it looks like visually. Tape reading style. We pop above $90. Then the first pullback can't reclaim $90 from below. Bounces get sold within minutes. Body closes fail. And $90 flips back into resistance. That is the trap pattern. It's not about whether you wicked to $30. It's about whether you can live there. If you can't, the market punishes breakout buyers. Then you watch the next key zone, $88. Because $88 is often the first meaningful retest area in this structure. If $88 holds, you can build a higher low. If $88 fails, you open the door to a deeper flush where leverage gets cleaned out. And here's the macro overlay that can make the bearish scenario worse. If the dollar is firm, equities are under pressure, and crypto is liquidating, forced de-risking can drag silver lower even if the long-term thesis is intact. In phase 1 of a liquidity squeeze, everything sells. In phase 2, the market decides what it actually wants to own. So if we're still in phase 1, don't be surprised if paper pushes down. That's the bearish case. Mechanical deleveraging dominates short term. Now bullish scenario. In the bullish scenario, the $90 defense during instability was genuine demand, not just constrained liquidity. And once conditions normalize, the market confirms it. What does that look like? We hold above $90 with body closes. Pullbacks get bought. Retests hold. Tests. $90 flips from ceiling to floor. That's acceptance. And once acceptance forms, the market starts targeting the next magnets, $92, then the mid-90s zone. But listen carefully. Even the bullish scenario can be violent. Silver is not a calm grind asset when positioning is crowded. Even in bullish trends, you can get sharp dips because hedging flows, stop runs, and risk management events are part of the structure. Volatility isn't weakness. Volatility is often repositioning. Now, I want to keep this from turning into a lecture again, so here's the fast version. The instability wasn't the story. The story is whether $90 holds once the market is clean again. If the market cannot break $90 even after conditions normalize, that's strength. If the market cannot hold $90 once conditions normalize, that's weakness. Price will tell you, now I'm going to give you a prioritized watch list, Tier 1 and Tier 2, so you don't drown in indicators. Tier 1, must watch. 1. Acceptance around $90 after conditions normalize. Body closes matter more than wicks. 2. Pullback behavior. Does $90 hold as support, or do we lose it and slide toward 88s? 3. Physical confirmation. Check 1O's coin premium percentage and lead times versus last week. Premiums aren't a prophecy, just a stress gauge, but they do confirm whether physical is acting tight or loose. Tier 2, secondary. 4. Margin requirement changes. Margins change behavior by forcing de-risking. They don't prove intent. 5. Options positioning, only if you actually trade options. Verify OI concentration on your chain by strike and expiry. If it's loaded near $90, expect more violent reactions around that zone. 6. Broader liquidity conditions. Dollar, equities, Bitcoin. Phase 1 is liquidation. Phase 2 is selection. Now let me add one more credibility guardrail because people love to nitpick words instead of understanding the point. We are not saying CME halted trading as a fact unless we have receipts. We are saying reported feed instability, free-to platform impairment, credence execution degraded. That's accurate, defensible, and consistent with what many participants experienced. And we are not saying silver definitely held above 90 as an absolute for every feed. We are saying silver stayed defended around $90 on the benchmark feed most of you watch. If your feed printed slightly below, that's not a contradiction, that's the fragmentation we're discussing. That's how you stay honest. Now we close with 3 takeaways and 1 unresolved tension, OG style. Takeaway 1, reported CME broker feed instability mid-rally degrades price discovery quality. It fragments liquidity, widens spreads, and makes confirmation and execution less reliable right when key levels are being tested. Takeaway 2, holding around $90 during degraded conditions is not nothing, but it's not a conclusion either. It can mean real demand, or it can be temporary protection from constrained liquidity. Confirmation comes after normal conditions return, body closes, retests, acceptance. Takeaway 3, anchor your view in verifiable reality. Check 1O's premium percentages and lead times versus last week. Track registered versus eligible trends over time. Verify options OI concentration on your broker chain if you trade that mechanic. Paper can expand faster than physical supply can respond, and that mismatch is where repricing pressure comes from. Unresolved tension. Was the defense around $90 the first sign of real acceptance, or was it simply the calm during instability before the next liquidation wave? You'll know soon by what price refuses to do next. Protect your capital. If you trade leverage, respect execution risk or it will destroy you. If you stack physical, don't let intraday noise rewrite your time horizon. And one last time, short and clean. If you have timestamped CME or broker receipts, drop them. Facts get pinned. Invest with logic, not hype.